Hello and good afternoon. Welcome everybody to another episode of the Investing with IBD Podcast. It's Justin Nielsen here, your host, and we are coming to you on July 30th, 2025, as we do every Wednesday, live at 5 p.m. Eastern. So hopefully you're either watching us live on YouTube or checking us out on any of the podcast forums that you use, whether it's Spotify, Apple, etc., etc. Hopefully you give us a like and subscribe so that we can make sure that we get this content to you as easily as possible. I also have to give, since it is July 30th, I have to give a quick little shout out to my 11-year-old little son who is turning 11 today, yeah, just chilling out downstairs. I have to kick him off the internet whenever I do the podcast, but he knows that in about an hour he can get back on and do his stuff. So let's get right to it because we've got a lot to talk about, and great first-time guest to do it with. Bob Lang has been in our kind of universe, I should say, for quite a while. I mean, you're friends with a lot of our IBD folks. Bob Lang, of course, is from explosiveoptions.net, the founder and chief options strategist there. A lot of people probably don't know this, that one of your claims to fame is that you came up with the FANG acronym. That was something that you shared with Jim Cramer. Gosh, how long ago was that?
Back in 2013, Justin, great to be with you, of course. So yeah, 2013, up until then, I was doing some of the off the charts for Jim. He would email me every month or two. Hey, Bob, what do you got for me for off the charts this week? So, he was doing these other acronyms, and I thought, okay, well, this one looks pretty good. Facebook, I like that. Amazon, yeah. Netflix, sure, that, and then Google checks the box. So I put them all together and I said, oh, FANG, that looks interesting. So I sent it along to him, and he just ran with it, and we got a good 10-year run on that thing. And everybody on Wall Street was doing FANG.
Well, and look, I mean,
credit for it in the beginning, but I
2023 and 24, it's still, it turned from FANG to the Magnificent Seven, and everything like that, and it's still certainly very relevant. We'll talk about a couple stocks that, of course, Facebook is now Meta, Microsoft is in there, in the Magnificent Seven. So we'll talk about some of the earnings there. But one of the things that is really interesting about what you do, Bob, something that I really respect, is you have this options knowledge that you bring to the table, along with your technical analysis, your swing trading mentality. And so you're kind of combining these things to really get the most that you can out of the market with some really fascinating ways in which you manage your risk. I think that's the important part.
That's exactly right, Justin. And it's all about managing risk. And I can tell you, I can go back to a time when, I was trading a lot of stocks. This is before I was into options trading, back in the late 90s. You and I both remember that whole .com period where it was like the Wild West out there in terms of technology, and people thought things were going to, they were like trees growing to the sky forever and the market was never going to go down. But we of course know that that's not true. And I lived during a time where, I did make a lot of money, but I didn't manage my risk carefully enough. So the one most important lesson I learned from that time period was to manage risk. And the one mistake I made was I was on margin, right? And we talked about this a couple of days ago when back in 2000, March of 2000, I think, IBD came out. Chris Gessel, who was the editor over there, came out and said, "Look, you know what? Time to get off margin."
Yeah. March 10th, 2000.
March 10th, 2000. I didn't listen to that great warning, and it cost me, and it cost a lot of people. And frankly, that was the one thing that shook me to the core and said, you know what, you need to pay attention to risk. You need to manage your risk much better, or you're going to suffer the consequences much worse than what happened. So that is one thing that options have helped me learn how to do.
No, absolutely. And look, Bob, I'm not going to out you, but you and I are not the young kids that we were back in the 90s. And so managing risk, look, I mean, you could be a cowboy and gunslinger back in the 90s because, okay, you lost, you lost money. If it was a good percentage of your account was smaller. well, now that we're getting closer to those retirement years, yeah, I don't want to take a drawdown like
No.
that. I can't afford to lose half my account anymore.
Yeah, there's just not enough time in front of you to recover that. You know what? When you're in your 20s, you think, "Oh, I got plenty of time. I can go ahead and recover it. I'm only in my 20s." But now, we're in our, we're not. We just don't have that much time. And again, we've already lived through those examples of bad trading and bad investing decisions where we don't have to make those same mistakes again.
Yeah, no, absolutely. So let's talk a little bit about volatility, because again, a lot of times there's two ways to approach it. Some people shy away from it, like, oh, okay, this is too much volatility, I have no edge. That's kind of how I approached the March and April time period. It's like, okay, this is too wild, not for me, I'm out. But they also say volatility can be a trader's best friend. So where do you come down on this?
So I look at it from a different perspective, Justin. I look at I do like it when volatility picks up, but not as an investor, but as an opportunist. And I'm looking for opportunities. And unfortunately, there's some people who look at volatility when it's rising and they start making choices and decisions, specifically getting out of names for the wrong reason whatsoever. Who understood why the markets sold off this afternoon after the Fed meeting and during Chair Powell's press conference? Who knew? There's a million reasons to sell, but there's only one reason to buy, right? So if you look at it from that perspective and say to yourself, okay, well, there's an opportunity there because people are getting out before some big earnings were coming out tonight, and we had Meta, and we had Robinhood, we had Microsoft came out tonight, when Qualcomm and so forth, and they're getting rid of these stocks basically for the wrong reasons, and now they're going to end up paying for it the next day. So I looked at drops like this today as an opportunity to take advantage of someone who didn't exercise the patience that was needed to wait on these stocks to see what happened. Look, could these stocks have fallen flat on their face? Sure, I highly doubted it. I don't think anything really changed from yesterday or last week to today to change my mind. But some people did change their mind, and they're going to end up paying for it tomorrow.
Mm-hmm. Well, and I guess one of the things that certainly in a headline-driven market, let's say, and I'll be honest, I know exactly what you're saying with the Fed. You could have told me what the headlines were. You could have given me all the sound bites from Jerome Powell's press conference and everything like that. I still don't know that it would have given me an edge in terms of what the market will do. So when you have all these headlines, and again, a lot of people approach earnings as this binary event, and it's not like it used to be before regulation fair disclosure, where you kind of had a lot of the wink, wink, nod, nod, whisper numbers that were kind of out there. Now it's kind of quiet periods and no one knows. And so everyone's trying to react very quickly. So, as you said, some of these could have fallen on their face. You don't know ahead of time. So how do you manage your risk? Is it just that, I've got enough cushion, I'm playing with house money, so I can afford to let these go a little bit? Or is it a way in which you're using options to say, okay, here's how I can kind of cut that risk and make sure I've got a defined risk outcome?
Well, you just said it right there. The beauty of options is that you can define your risk. You know exactly how much you can lose. And that's an important factor that is lost on people who trade options. They don't understand, they don't remember the fact that, hey, look, if I buy a call for $8, that's the most I can only lose $800. That's it. I can't lose any more than that. I can certainly make much more, but I know exactly where my risk is at. And if I can manage that risk on a regular basis and say to myself, okay, well, I'm not going to overshoot. I know we're going to probably get into position sizing a little bit later on, talking about this. That's important as well. But certainly managing that risk. So I would look at a trade, getting into a trade like a Meta today, and I look at the call options and see what they're priced, and they're overpriced because the market was expecting about a 7% move, and I want to say it's moving about 8% now after hours. Expecting a big 7% move is huge, and for this particular stock to get up on those numbers, the market maker is going to make you pay up for those options if you want to play and participate. But you could do it in a much more controlled way and controlling your risk by spreading the trade out. So, I mean, what I did at the end of the day, Justin, I bought a 7:10 call, which is expiring on Friday. It was about $15, but that was a little bit too much for me. So I ended up selling the 7:30 call for about $8. And I'm sorry, 7:35 call for $8. So I created a $25 spread, 7:10 by 7:35, that cost me $8. So instead of 15, I'm getting in for about 47% less than just buying the straight call. Now, how's that going to work out for me? Well, hopefully, if I see the stock trading at 7:55, it's over the short strike, so it should push that spread should push out towards that $25 level, which won't exactly get there until the end of the day on Friday. But still, I only have to wait 2 days to let this trade play out from 9 out to 25. So it's almost a 175, almost 180% return in about 2.5, 3 days. So if the stock had gone down, of course, if it does go down, if I decide to hold on to it and I get it does pull back below, say, 710 or something like that, I'm only going to lose the $900 that I put into it on the spread rather than the 15.
Now, of course, one of the things that some people have a problem with there is that you've capped your upside. So here we are trading at 754, and if you have this case where you had your short call at 735, what have you, there's some upside that you're losing out on, right? That's the you can't have your cake and eat it too, right? You have to give up something in order to lower that risk. So how do you kind of choose your strikes and say, okay, this is how much room I'm going to give myself on the upside, and versus the premium, I guess, that you're risking. How do you kind of manage that? And then also, of course, I want to get into the expiration date, because in this case, you chose a very near-term expiration. This is one of those things where it's either going to work or it's not, right? There's no room for adjusting this.
Yeah. So basically, I'm willing to accept that loss of the potential upside, because that's what I'm giving up is potential as opposed to guaranteed upside. So if I'm going to buy at 9 and I'm going to sell it, say, close to 25 by the end of the week, if this thing holds up, then I'm feeling pretty good, feeling pretty confident that I can wait things out and let things work in my favor. So as far as picking the strikes is concerned, Justin, I looked at the potential for the expected move, which was about almost 7%, and that was about $50 from the close. So that took me up from about 694 to about 744. So we're above that right now. Yeah. But I was looking for something that I really had a little bit more confidence in the fact that if it does make that expected move, I don't have to worry about playing around with it in the next couple of days where it's going to sell off $4, $5, going to go up $5, and so forth. I can feel pretty confident that I can just sit there and wait for the spread to widen out to as much as possible to close to that $25 spread.
And just real quick, because some people might not be as familiar with the expected move or expected range, I usually, to kind of gauge that for myself, I take the near-term expiration, I add the at-the-money call plus the at-the-money put. Now, some people apply a factor to that, 0.7, 0.8 or whatever. I just kind of say, okay, well, just to make it easy, I'll just take the straight number. What is it that you do to kind of get that expected range?
I do the same as you, Justin. I just take a look at the at-the-money call, which is basically the straddle, at-the-money call, at-the-money put. And so the 695 call and put together was worth about almost $50, $52. So adding that together in there got you up to about the 742, 740 or 746 level or something like that. So So I could. Well, yeah. I mean, there's the beauty of these option spreads is this, Justin. There are a lot of right answers. There are a lot of trades out there that can work for you. Some are better than others. Some are more risk averse, and some are more risky. So, but somebody could have bought a 720 call. I went with the 710, 735 call, And it looks like we're both going to make money.
Yeah.
Right. So
Mm-hmm.
that's the beauty of this whole thing. You don't have to go with exactly the one that I did or exactly the one that you did. You find a trade that's very similar. You could have sold puts, sold naked puts in this one too, which are probably going to go down quite sharply between tomorrow and Friday. So there are different ways to skin a cat, I guess. The saying goes. There's different ways to go to make money on these particular trades if it's working in your direction.
Mm-hmm. And I guess one of the things too, this is to use the lingo, more of a bull call spread, right? Because you started with the long, and then you again you lowered your risk with that short call.
Yes.
Why go with that instead of, say, a bull put spread, where you're using the benefit of a higher implied volatility ahead of the earnings? If you're going to take a direction, why do you go with the long side with that high implied volatility as opposed to the short side?
So I looked at the bull put spreads because I do like using those as well too. But in this particular case, I got a little bit more juice out of the long call than the short put. So long call being the 710, I was looking at selling like the 750 by 720 put spread, which is probably going to work. That's a $30 spread. I could have picked up about close to about $18 for that. So that was going to work pretty well. But I think that the problem here is this, Justin, is if the stock goes up, what I really want to do on a spread like this is hold on to it as long as possible, right? Mm-hmm. So remember something: when you're a net seller, the clock is working in your favor. So when you're a buyer of calls, the clock is against you. So as of tomorrow, this spread is going to work, but I don't think it's going to work quite as well if I want to close it right away on the call spread. I think I would really have to hold it and sweat this one out a little bit longer on the short put spread.
Mm-hmm. Yeah, and then one more thing on this is because again, you don't really have room for adjustment, and as much as we talked about the expected range, we should mention that when you do the math there and you come up with that 50 points, let's say, for the expected range or expected move, that doesn't tell you direction, right? A lot of people forget that it's that could be in either direction. So what makes you kind of say, hey, this is the direction I'm going to go for this particular stock?
Right. So the charts really are the thing that guide me in making my choices and making my decisions. And look, I mean, I play no favorites when it comes to charts. The charts tell me they have a lot of data points. I'm looking at the chart right in front of us here. There's a lot of data here that tells us good information about how strong the trend here in this particular case is in meta. And I see you've drawn a nice cup and handle pattern, which is one of Bill and
pattern recognition did it for me. So
okay, but it's certainly
the computer did it.
It's certainly one of the signature patterns that Bill and Neil coined this term, decades ago, and it's tried and true and one of the most reliable patterns out there in the technical analysis universe. So I look at something like this and I say to myself, you know what? I mean, the patterns don't lie. This is just people's actions and activities that we see happening on a daily basis here. So the patterns don't lie here, Justin. And I look at that and I say, look, the market, the stock here is in a bullish uptrend. Yes, is it pulled it back a little bit over the past couple of weeks? Sure, but nothing serious. The volume hasn't been really high as the stock has pulled back, and it's just giving you an opportunity to get in on this particular trend. Now, obviously, if you go back a little bit further back earlier in the year, and you saw that same sort of thing happen back in January, February, you see the stock peaked and it came back down. It's clearly in a downtrend, right? I'm not interested in. I don't care when earnings are coming out. I'm not interested in a bull call here, a bull call spread or a bull play, unless it's turned around and starting to make higher highs, higher lows. Textbook definition of an uptrend. So the fact of the matter is the stock has been in an uptrend. The charts don't lie, and it's been telling me the same thing for weeks.
Mm-hmm. Now, I want to also just kind of take a step back and look at the overall market, and how much does the market kind of I guess inform your decisions on individual stocks, because we certainly it's been helping that we've been in a big uptrend for the markets. And of course, when you're dealing with something like Meta, that is one of these larger market cap weighted stocks, you're seeing more of that weight here in the Nasdaq Composite. So what is the overall impact, I guess, of the market on some of these individual decisions you make?
Oh, it's been huge. I mean, I look at something like an Nvidia or a Meta or Apple and Microsoft, all these names that are in the Mag 7 that you spoke of. They have enormous influence on the markets. But I also I don't want to dismiss the fact that for the past 6.5 weeks, the big influence that I've seen on the markets has been from the Russell 2000, and the Russell 2000 clearly having some difficulty breaking through that 225 level. On the IWM, and that has been a sore point for this. Yeah, that's it right there, 225 or so. And I think that maybe some of the earnings, and maybe obviously tomorrow, the 31st being the last day of the month, we do get a lot of window dressing coming in. The IWM has been fairly weak this week, so I'm thinking that perhaps with some of these companies coming out with earnings in early to mid-August, a lot of the Russell 2000 names will be reporting. We might see a nice turnaround over here. The reason why I'm focused in on this IWM is this, because this is 2,000 names. This is the broadest index of them all, and when we see this index leading the rest of the markets, it does it in a big way, whether it's up or down. So I think over the past 3 months or so since that bottom in April, I think the IWM has been leading the markets higher. We see breadth expanding at a record pace. We saw new all-time highs in the cumulative volume breadth just a couple of weeks ago, which led into new all-time highs in the S&P 500 and the Nasdaq. I think eventually the Russell 2000 is going to get to those all-time highs, which is about 240 on the IWM, and 242 or something like that. So once we get up there, then it's then I think it's really game on, Justin, for the uptrend. I don't know how long it's going to take. It's been a while. I mean, this index has moved in fits and starts for months now. But now I think that this recent bottom here is going to prove to be very important.
Yeah, there were definitely a lot of these breakouts that would, you'd get maybe 2 weeks out of it, and then it seemed like it was right back into its base.
That's right.
And then it's also worth kind of maybe looking at the overall monthly chart here, because one of the things that does stick out here is that the Russell 2000, here's our relative strength line versus the S&P 500, and the Russell 2000 has been underperforming for quite a while. Again, it really has been your $1 trillion club, if you will, as opposed to the small caps. And some people say, well, gosh, the Russell small cap index has a big hurdle, because basically the most successful companies get taken out of there, right? The ones that work get taken out of there. So what do you say about this kind of lagging relative strength? I mean, I look at the monthly pattern here, and it's hard not to be intrigued by this big cup with handle, but it certainly does have that relative strength that's been lagging.
Well, there's a deep relationship between the Russell 2000 and interest rates. So when interest rates are low, and you saw this, what happened when interest rates, look at the chart there back in 2020, when interest rates went to zero, you saw the enormous outperformance of the Russell 2000 for the next 2 years, right? For between 2020 to 2021. Well, we also saw that happen back in the Great Financial Crisis as well too, back in 2008, 2009. Over the left, you have the left exactly right there. So we saw good, strong outperformance from the Russell 2000 versus the other indices for a good period there of several years, because interest rates were low. Well, interest rates aren't low right now. 4.25. The Fed came out and kept rates where they are. And one of the reasons why the market did fall towards the end of the day today, Justin, was because Chair Powell came in and said, well, the economy is growing strong. 3% GDP came out this morning. Prices are low. We're a little bit hot on the PCE core, but you know what? The economy is doing great right now. With interest rates where they are, and until inflation gets down to our 2% target, which has been talking about for months and months and months, we don't really see a need to move interest rates down. But if they do eventually cut rates, which I think the next one could come in September, Justin. I said back in February, I was on record as saying the Fed won't cut this year. I'm sort of 30% into that camp right now. I think the next cut could come in September. I think there are some people on the Fed who believe that, hey, listen, you know what, inflation is coming down. We don't really have to worry about we've already won the war on the jobs situation. That, you know what, once I think another cut, maybe 2 cuts, is going to be extremely important for these small caps to rally.
Mm-hmm. Yeah, no, very good point. And a lot of folks, again, we're waiting to see. The expectation for a rate cut today was, I think, minimal, 3%, maybe less. But it was really about, okay, what does Powell say in terms of opening up that door for September? And it was interesting that a lot of people were pointing out that this was the first time that 2 governors on the board of governors of the Fed dissented since 1993. You've had 2 officers dissent, not too long ago, but 2 governors. It's been a while. But of course, this is one of those things where, again, going into today, we expect to see some volatility. There's always, the announcement, which the market does its thing, but it feels like the press conference is really where the volatility can really come in, because
Sure.
if Powell coughs wrong, then it's, all hell breaks loose. So, just like with earnings, as you were kind of talking about that with Meta, how do you approach, because again, you give me the headline and I'm not going to necessarily know how the market's going to react. It's only until the market starts reacting that I can make sense out of it. But how do you handle going into something like this? A lot of people were probably fretting a little bit as the market was coming in, but you were, again, looking at this as an opportunity.
Right, and I had a lot of confidence that the Fed was not going to do anything. Obviously, the Fed funds futures were portraying that as well too, that the Fed was going to stand pat today. I do think that the next meeting in September is reflecting more of a chance of a rate cut. But as today is concerned, I was looking at a lot of people who were, still believe that there was going to be no movement in rates today, but still they came in with some nervous hands, and not with the diamond hands we like to talk about. So I think there were a lot of people who were nervous and a lot of people who were concerned that the Fed, especially Fed Chair Powell, was going to say the wrong things. He didn't say the wrong things. He said it was he's always been a straight shooter, especially last Friday when he was talking about the Fed building. He's been a straight shooter all along, and I take him for his word. And in the past he's made mistakes, but I think coming into this meeting, it was important to kind of understand that they're going to stay pat, and the markets we're going to accept it and move on from there.
Mm-hmm. So. Just to kind of shift gears a little bit, one of the things you and I were talking about on Monday when we got together was this whole idea of FOMO. And again, you look at how much this market has come up. There was a lot of wringing of hands in terms of the tariff situation. It was introducing a big unknown. There were a lot of there still are a lot of arguments over what this is going to do to the economy, and everything like that. And look, I'm not smart enough to know. I just look at the chart. I let the market decide, and I go from there. But certainly at this point, the fear of missing out is strong, right? If you didn't get in early, you've been kind of looking from the outside and looking for your opportunity. And this has just been trending up in such a strong way. So how do you, if you're doing some of these short-term options, how do you kind of get new positions to keep on participating here in this market when some of these are limited in terms of their expiration? And okay, you're out of that trade. Now what?
Well, there's a couple of things there. The first thing is that I learned a long time ago the best trends barely give you a chance to get in. Mm-hmm. And that means basically, the best trading trends do not give you an opportunity to get involved and to get a position on. The market, the stocks or the indices, they don't dip long enough in terms of time or duration to give you that opportunity to get in. Maybe today it was only like the last hour of the trading day to get in. That's a very small window, Justin, if you're thinking in terms of the bigger picture here. But by the same token, I look at market volatility in the 16% range, and I have to say to myself, look, you know what? While there's a lot of complacency in the market, we've been down here for quite some time, and we've been coming down from higher levels. Remember, back in April, we were at 60% on the VIX. We've come down quite a bit, and I have to figure that the market is fairly confident that we're not going to have any big surprises right now. I always want to have some insurance on. I always have some puts on, and they really rose up in value towards the end of the day today. They're probably going to get smashed tomorrow, and I'm okay with that. I got to have some balance there, and that balance of having some puts on because the markets go down a lot faster than they go up, and having some calls on gives me that balance there to eliminate some of the market volatility that's in my portfolios. But I can still make some good money on the upside if my calls are correct.
Yeah, and you know what? I think that's something that a lot of people forget in terms of with some of those puts that you might be putting on. You're more than okay for those trades to not work out. It's one of those things where if it's hedging something, if it's giving you that insurance, who cares if you paid a little premium for insurance when your house is protected, right? No one complains, oh well, gosh darn, my house didn't burn down and I didn't get the value of that premium. So yeah, it's really, again, you have to kind of change your mindset instead of looking at like, oh, those puts were worthless and I didn't make any money on them.
Exactly right. And I look at it in terms of like, we pay for insurance every month for stuff like life insurance, health insurance, auto insurance, mortgage insurance, those sort of things. And we hate writing those checks, but we're happy if a disaster happens. It's no different than what we're doing in the stock market these days. Investors protecting our portfolios. I'm happy writing that or buying that put if it's going to protect me against some downside risk of the markets, which I have no control over, and I really can't. If I don't see it coming out in the future, nobody can see the future. Nobody's Nostradamus. If we can't see what's happening into the future, well, I mean, we could get clipped at a moment's notice. And if I don't have any protection on, I'm gonna be in a world of hurt.
Mm-hmm. No, absolutely. You know what? We talked quite a bit about Meta, but I also wanted to address Microsoft.
Sure.
Microsoft, of course, has been trending very nicely, and it has, looks like it's up 7% in after hours. What's kind of your take here on Microsoft?
Well, I have a position in Microsoft to have some calls, and one of the things that stood out to me, Justin, was the option flow that came in over the past couple of weeks. It's been very strong, a short term and medium term, which means short terms, meaning this Friday and the next couple of Fridays. Medium term, meaning September. We saw a lot of options flow. What does that mean? It means a lot of option buyers were coming in, buying calls hand over fist, day after day after day. It wasn't just like 1 day or 2 days. It was days and days and days in a row. People were coming in buying, and that's how big institutions play, right? Mm-hmm. With options, especially. They don't just make a big splash and buy it all in 1 day. I know you've managed money in the past, and I suspect that you didn't make all of your purchases in one particular day, but you spread it out over several days, just so the market doesn't know what you're doing. They don't pick up what you're doing, right? So it's the same thing with options. And I think what we have to understand is that if we see these clues coming on, we have to pay attention. And they raised my antenna up a couple weeks ago, and I said, you know what, I'm gonna jump in on some calls here. And again, with all the rules of options trading, defined risk, I'm able to spread them out if I wish. In this case, I didn't. I just played some straight 520 calls. And looking, hopefully they're going to rip to the upside tomorrow, and I'd be able to take them off and roll them up, and if I wish, and bank some profits.
Mm-hmm. Now, one of the things we also should address here is because, again, with how extended some of these stocks are, they've been running for so long, and the market has too. So where do you start setting your levels? I mean, again, if you're like looking for a pullback, which again would be very normal. I guess the thing here is, where are you setting your guardrails?
Well, you have to remember something. Overbought is simply a condition. It's not a signal, right? Mm-hmm. Overbought condition can last for a long period of time, right? What did what did John Maynard Keynes say 100 years ago? Markets can stay irrational longer than you can stay solvent.
Right. Yeah.
So I'm not saying that the markets are irrational, but certainly behavior by people in the markets can be, and often is, very irrational. So I think if you look in terms of an overbought condition and expecting and waiting for a pullback, the timing of such, we're never going to get it right. So that's why I think that if you have some protection on, I don't know, maybe today was that pullback we were looking for. It only lasts an hour,
It's not pullbacks of the 50-day; it's pullbacks of the 10-day at this point.
That's right. And maybe that was enough to reset the market for a move higher. Who knows, right? But I think that having some puts on and having some protection on in the meantime. And look, if that protection turns out to be poor, we could just dump the puts and move on to the next trade and move on, and hopefully our long positions are going to override those losses.
Mm-hmm. No, absolutely. Want to talk a little bit about some of the other trades that you've done recently. I know CDNS Cadence Design was one that you brought up to me. Maybe walk us through this one, how you handled it.
So Cadence Design had an earnings out on Monday after the close, and I've been looking at this one for a while. Another name that just like this one is Synopsys. SNPS is the symbol of the same business. They're doing an acquisition of Ansys, and so these two stocks tend to run together. So Cadence, again showing a nice pattern of higher highs, higher lows. More recently, the last 2 months. Option flow has been good. Relative strength has been improving quite sharply, and volume levels have been really good. Volume trends have been bullish, so it made a lot of sense. And then a plug for IBD here. I happened to look over the weekend, and it wasn't Ken Sharif who wrote it, but another one of his colleagues wrote the earnings preview over the weekend and picked out Cadence as one of the names that he liked. For an options trade. So that kind of was the clincher for me, Justin, to say, look, this is a good trade here. So I looked at it on Thursday or Friday. It was Friday afternoon, actually. And I said, you know what, let's put a call trade together. So I bought some 340 calls on this one, and it hit a home run on Monday.
Yeah. And I'll be honest, I was watching this one myself, and rather than doing an option play on it, I was looking at this breakout, and really, I've made money on Cadence before. I like their story. You look at the fundamentals, because I know we've talked a lot about technicals, but fundamentals matter too. I mean, 21% EPS growth rate on an annual basis, huge. And the stability of 4, meaning that the earnings are very stable. So I was, we were talking about this on IBD Live. We were, I was looking at it, and I'm like, 2 days before earnings, forget it, and here you are again. There's a lot of options with options, if you will, in which you can structure a trade to minimize, not completely erase risk, but minimize risk and go into it knowing, okay, I've got my worst case scenario ahead of me, and it's an acceptable level of risk.
So in this particular case, the options were kind of expensive. I think I want to pay. Let's say I paid $9 for the 340 calls, which I ended up selling at about 25 on Monday. I'm out of the name now. I'm probably out of it too soon, but I'm looking for a little bit of pullback here. The key here for this name, for all the listeners who are watching this, is that Tuesday, you see that bar on Tuesday where it gapped up. If that low holds for the next couple of days and it runs back up, I'm gonna preach, Justin, another rule of thumb that Bill O'Neill came out with many years ago. If it breaks out within 4 to 7 days on higher volume, that's it. You're good to go. I might have gotten that wrong, but I not sure. Is that?
There's a lot of different rules and exceptions to rules that he's talked about over years. I mean, there's certainly, when you get power, that was something that he was very big on. A 25% move in 1, 2, or 3 weeks, that was like an 8-week hold rule for him. And that's right. But yeah, it's when you see a strong breakout like that. Granted, a lot of the historical examples that he used from each market cycle in the model book study didn't have as big a moves maybe as before regulation FD, but you adapt, right? The market changes, you gotta change with it.
Exactly.
I want to talk a little bit about position size, because
Yeah.
one of the things about these, some of these options you're talking about is, okay, Microsoft, that's a $500 company. Meta, that is, almost, 700, almost 800 now after the earnings report. It's up 12% just while we've been talking, up another 4% in after hours. And even Cadence, this is a $371 company. So for some people, I mean, if you've got a smaller account and you're going in with, one contract is 100 shares, so that's what, $37,000 potentially of a position that you're controlling. How do you kind of say, oh, this one's too much? Or I know you can certainly reduce your risk, as you did with Meta, with a short call, but how do you kind of address your position size that's appropriate for the size of your account?
So position sizing, much like is managing risk, is one of my favorite topics to talk about. So I think position sizing is critical to keep somebody in the game over the long term. And I've come across over my nearly 3 decades in the markets a lot of people who have come to me and said, hey Bob, I found it. I found the silver bullet. I have the method. I've done the back testing. I know that this system I have, I can't miss. I can't lose. Okay, great. So what ends up happening, Justin? They end up going all in on this particular system, and what happens? It fails, right? Yeah. I get the call later on, Bob, I don't know what happened. I just knew this was going to win. I had all the proof. I had everything there. Did all the back testing. I just don't understand it. And I said, you know what? The market gods don't look upon that attitude very well. Yeah. And market gods will strike you down if you're not careful. And obviously I'm being a little facetious here, but seriously,
not really. I mean, long-term capital management. I mean, remember you had you had the best and brightest Nobel laureates, and it was the 0.1% case that they didn't account for. That
talk about being over your skis, right?
Yeah. Yeah.
So So position sizing is the thing that will save you from disaster. And I size I have a lot of positions in my portfolios. I think I have one portfolio that's got like 50 positions in it. I've got some stuff that's expiring in the next couple of weeks. I've got some stuff in September, some stuff in October. I spread it out. I like to spread my risk around. I diversify pretty well. And somebody may ask, well, how do you manage 40 and 50 positions? And
that was going to be my next question, Bob.
very carefully. I'm always scanning. I'm always looking for stuff. And if I say to myself, look, I've got too many positions on, I've got too much risk on that I feel like I can't handle at this point in time, well, I start firing and hitting the sell button over and over and over again on stuff, and say, do I want this? No. Do I want this? No. Do I have duplication? Yes. I gotta get rid of one. So I start firing stuff, Justin. It's crazy. And so my wife sits behind me in my office at home, and she's like, she hears it all the time, but it sounds like a seal is making a noise when I keep hitting the sell button over and over and over again. So she goes, oh, you're selling, aren't you? I said, yep. I'm cutting stuff. So managing the risk size is so important. Position sizing, it will save you, save your bacon over a long period of time, and it will allow you to continue to participate and find new ideas. Because let's face it, if you lose all your money, there's a parable comparing to poker. Okay, if you're out of money at the poker table, Justin, then you're on the rails. What is the rails? The rails on the outside looking in.
Right.
So if you lose all your money in the stock market, you're going to be put on the rails. You're on the outside looking in, unless grandma dies and she gives you a lot of money to trade. But if you're on the outside looking in, you're not participating. It's probably because you sized your positions too big. You didn't manage your risk, and you're learning a very valuable lesson but you're not able to participate out in the future.
Mm-hmm. So do you have a rule of thumb in terms of are you looking at each trade in terms of like a risk to your portfolio? Are you looking at the individual trade risk to determine your portfolio? I mean, your position size. Are you using some type of formula, or is it just kind of like, okay, what's the worst case that can happen? Am I okay with that?
So obviously options give you a great amount of leverage over stocks,
Right.
right? So you can get anywhere from 10 to 13, 14 times leverage with options versus stocks. And I generally have no more than about 60% of cash being used into options at any one time. Sometimes a little bit more, but it's usually less. In times like this, when the markets are hitting all-time highs, I have quite a bit less risk exposure there. As far as trades, individual trades are concerned, if I get to put a 2% position on, so if I have a $100,000 account, I'm probably buying options that are worth about $2,000, maybe $2,500. That's enough. I don't need to hit home runs over and over and over again. And that's another thing. Most people that get into options are expecting to hit home runs. You hit a few singles and doubles, and those runs add up. In baseball, it's no different than options trading too. So hitting a couple of singles and doubles regularly, and then the occasional home run makes it feel really good.
Yeah. And I think that's so important, because I think, of course, in a market as strong as what we've seen, there might be the tendency to say, well, gosh, I'm things are working and I'm getting even better gains with this leverage. You can quickly see a 20% year turn into triple digit. And then you think you've got to use all the resources you have available to you. But it's interesting that you say you're comfortable being 40% in cash, just to make sure that you, again, don't get ahead of your skis. You're recognizing the leverage that you're using, and you're balancing it with a larger cash position and
exactly
being
right.
careful. Yeah. So, I think that is absolutely so important. And then, one of the things also that I want to make sure we kind of discuss in that regard is, as you said, with all of the positions that you have, are you doing things like to get yourself delta neutral? So are you doing like some areas where you're like, okay, I'm bullish in this area, but I'm going to counterbalance that with some bearish puts or bear call spreads or bear put spreads over in this area that's maybe not doing so well? Or do you just kind of like, if the market's good, I want to be on the same side as the market?
Yeah, and really, this stock market, certainly since the bottom in April, has become a great stock pickers market. And by and large, most sectors have done fairly well since 4 months ago. So I truly believe that finding those names that are working has become a lot easier right now. It may not be easier in the next 3 months, 6 months. Certainly in the next end of the year, I think we're going to have some challenges as we approach 2026. But certainly buying some options on the indices, like the SPY or the QQQ, is the easiest way to go to protect yourself, as opposed to just trying to find a needle in a haystack. Now, certainly there's some sectors that haven't worked very well this year. I will tell you that there are some, like even before about a month ago, home builders were just atrocious. I mean, every chart in the home building universe was just awful. And even some of them today are still not great. But you have to pick and choose and find the areas that aren't working for you. But certainly, just buying some puts on the indices is a lot less painful than just trying to find the names that are working badly in the markets.
Mm-hmm. Well, Bob, I got to say this was a lot of fun having you on. I don't know why we didn't do it sooner. Of course, you've been friends with Ken Shreve and Chris Gessel for a long time, and I'm so glad that you came on. I also want to make sure that people understand. Hey, you've got a book out that people can read to kind of get a little bit more on your philosophy here. The book is called Know Your Options: How to Trade Options for Income Using Technical Analysis. You also are on X at Aztecs99. And then, of course, there's your website where you're the founder and chief options strategist at explosiveoptions.net. So thank you so much, Bob, for coming on the show. Really appreciate it.
Great to be with you, Justin, and thank you for having me and all the subscribers and people out there in Investor Business Daily. It's great to be with all of you.
Yeah, I should point out that I was looking at the YouTube comments. A few folks were commenting on how they know your work and they just really appreciate your teaching style and how much you're dedicated to the education part of getting people up to speed on options. So we appreciate you sharing that knowledge.
That's really nice of them to say, and really I pour it all out for everybody to try and help them become better options traders and better technical analysis, and that's what it's all about.
Yeah. Okay. Thanks a lot, Bob.
Great to be with you, Justin. Thanks again.
Okay, that's going to wrap it up for us this week. Thank you so much for watching, and make sure you tune in next week because we're going to have David Keller back on the show. David Keller, of course, he's struck out on his own. He's at Sierra Alpha Research now as the founder there, and of course, chief content or chief market strategist. I suppose content as well. He does it all pretty much. So it'll be great to have David Keller back on the show, and we hope you join us for that. Again, you can follow us on YouTube if you just go to our channel, or you can get us wherever you get your podcasts. But we will be live at 5 p.m. Eastern next week on Wednesday. Hope you join us. Take care. Bye-bye now.